Bueno, ya ahora sí, nos acercamos al evento fulminante, la plática que todo el mundo veníamos a ver con Jeremy Siegel. Y bueno, me gustaría nuevamente agradecer a Pichi Compass y WisdomTree por hacer posible que Jeremy nos acompañe el día de hoy. Y bueno, para presentarlo, nos va a acompañar aquí en el podio Guillermo Rodríguez, CFA, que también tiene una historia larga como parte de la sociedad aquí en México apoyando y bueno, le agradecemos mucho esa iniciativa que tuvo para hacer esto posible y que bueno, todo este evento se pueda llevar a cabo. Guillermo Rodríguez is a senior investment executive. He currently serves as head of Latin America and U.S. offshore at WisdomTree, one of the world's leading ETF providers, advising institutional clients across Latin America and the U.S., with more than 35 years of experience in the asset management industry. Guillermo.
¿Qué tal? Buenas tardes. Mi nombre es Guillermo Rodríguez. Pequeño comentario. Hace 5 años fue cuando obtuve mi charter. A diferencia de muchos de ustedes, yo recibí mi charter en un tubo y me pregunté, seguramente va a haber una ceremonia, ¿no? Me puse a investigar y dije, pues voy a contactar a la sociedad. Y pues la verdad es que en ese entonces no había lo que existe actualmente y pues no hubo ninguna ceremonia ni nada. La realidad es que busqué, no existía la sociedad que existe actualmente y pues no hubo la ceremonia. En ese entonces había, yo creo que unos 80 charter holders, muchos de ellos extranjeros, y en ese entonces nos reunimos y empezamos a crear la sociedad. Empezamos a hacer varias cosas, creamos el primer Research Challenge, los partnerships con las universidades, y la verdad es que es muy padre lo que ha logrado la sociedad actualmente, porque pues, en los 10 años que estuve trabajando aquí en la sociedad, la verdad es que los números de charter holders pues, no crecían mucho, ¿no? Y llegar a los 500 miembros se veía muy difícil. Y viendo lo que ha logrado la sociedad, creo que ha sido un logro muy importante. Y la verdad es que felicito a todos los que han participado en este logro. Y por otro lado, pues como habiendo participado por 25 años en diferentes sociedades, en la de México y en la de Miami, pues creo que es muy importante lo que han logrado. El network del CFA Institute es muy importante y una de las cosas que se ha logrado es que, pues, como miembro del CFA Institute, pudimos cooperar, trabajar en conjunto y poder traer al profesor Siegel, con la obtención de algunos de los miembros del board aquí de México, pero pues poder lograr eventos como este, ¿no? Participar dentro de esta red es muy padre, conoces a gente muy interesante y pues ojalá puedan disfrutar de la presentación del profesor Siegel. Gracias. El profesor Siegel ha estado involucrado con WisdomTree desde los inicios hace 20 años. El profesor Siegel, como saben, es una eminencia en el mercado financiero. Por cerca de 50 años ha sido un académico muy importante, principalmente en la Universidad de Chicago y por muchos años en la Universidad de Wharton. Es muy reconocido por sus comentarios en el mercado. Como decía Mark, es una persona que es muy energético y lo vemos en CNBC y en medios con sus views del mercado, a veces criticando a la tech, en que se tarda en reaccionar, etc. Y seguramente hoy oiremos algunos de esos comentarios. Y también es muy conocido por su libro Stocks for the Long Run. Editaron la 6ª edición. Y pues bueno, yo creo que en lugar de hablar de sus experiencia, pues tenerlo aquí y que nos platique de su view actual del mercado. Entonces, sin más, Professor, welcome to Mexico, and the stage is for you.
Thank you, Guillermo. Thank you, Mard, for those wonderful comments beforehand. It's a pleasure to be with the group. I think of all the groups that I talk to, the CFA groups are the ones that are my favorite. And I'm going to talk for about, 35, 40 minutes, and then I'm going to open it up for questions. And any, think of them during the time, and I'll be happy to do my best to answer them. Many of you know stocks for long run on the right there. Is the 6th edition, which was published about 4 years ago. So the first edition was published in 1994, so 32 years ago. So let's take a look at this is about the lawyers put this in, so there. Okay, you guys have seen this graph before. Long run real returns. This is updated here. And the major classes of financial markets, I went all the way back to 1802. Right. There we go. Compound real return over these, 224 years in the United States is 6.9% after inflation. In the first edition, which did that up to 1992, which is actually 34 years ago, it was 6.7%. So we've had a good run, certainly. This also, by the way, if you're interested, this does make it, from 1900, there is that book by Stone Demoy and Marsh called Triumph of the Optimist. And many of you may get their yearbooks, so they go through about 30 countries. Up until about 5 or 6 years ago, actually the U.S. was not. Actually, number one was amazing from 1900. It was actually South Africa in dollars. But now the U.S., with its run over the last 2 or 3 years, is definitely the number one. You can see the trend line. This is on a logarithmic scale. Straight line represents constant real return, as you guys know. I always like to summarize the main concept of stocks for long run. The stocks are the most volatile asset class in the short run and the most stable asset class in the long run. And you can see no other asset class has the long run stability of real returns as the others. There's the two important things I want to focus on this, and one in detail on the next one. First of all, the blue line at the bottom is the value of the dollar, purchasing power. And it remained remarkable. Look, it was the same. We were on the gold standard. It was all basically on the gold standard. And it stayed stable until about 1940. over the last, I guess, 85 years, it's depreciated to a value that is, about less than 4 cents on the dollar. So 2,500% cumulative rate of inflation. No negative impact whatsoever on the real return. It's astounding. You look at the stock line, when prices were stable, as they were for 140 years, and then the prices there was inflation chronic for 80, and there's no difference. And of course, what's the conclusion? Stocks are nearly perfect long-term hedges against inflation. Real. Almost perfect. Second thing, gold. Over the whole period, gold doesn't look so good. 0.9. Of course, during most of the time it was part of it on gold standard, so it was 1-to-1 with the price level. It should be 0, and then since then it's gone in. So a lot of people say, well, what you really have to do is from 1971, when gold was freed by Nixon, and from the price level. So by Nix, I'll ramp baby here. Yes. So, from 1971, and I have 3 time periods here. If you got it just as Nixon released the price. Now remember, it was way underpriced. It was at $38 an ounce. Actually, it's 35. It had gone up 38. It was thick. Way underpriced. That's why we were losing gold. We're losing so much gold. Nixon said, okay, no one gets gold. Foreign central banks used to turn in dollars, gold no more. So they freed the price, let Americans own gold, which they couldn't own bullion before that, believe it or not. But then they could. If you got it just as he released the price, I mean, those are the real returns. Now, for stocks since 1971, that's what, 55 years. What's the real return? 6.9. Isn't that interesting? That's the same as over 224 years. For gold, it's what, 4.8. Yeah, and bonds is 2 something. So gold is okay, quite good, but in bonds, not as good as stocks. But what happens if you take it from the peak in 1980 when we had the worst inflation that we've ever had, and gold soared to $850 an ounce? Well, it's in last place from there. Real is, 2 point whatever. But a lot of my gold friends that love gold say, let's take it from the turn of the century. And if we do that right there, gold turns out to be number 1, better than stocks. Now that's still a long period of time. But I want to show you how, when people talk about long-term returns on your gold, be very careful about what is your starting point. From 1802, it's 0.9. But from these other things, it could be anywhere from 2 to 8. Now, by the way, the last one was at the peak of the internet bubble and a low point for gold. So, you're starting from the most favorable spot ever. What you should also know is that gold seems to have the following pattern. It rises quite strongly, as it did from 1971, 1980. Then it fades down. Then it rises again. Then it does nothing and fades down. And then it rises again. And we're probably maybe at the top or near the top of one of those rises, which takes a prelude to a period that is usually not that favorable for gold. I'm not bringing anyone who wants to hold some gold, a sliver of your portfolio. I think it will in no way give you returns on stocks, may not even give you the real returns on bonds, although TIPS bonds right now are too. And I guess, when you talk about, when gold was only 2% back then, so even at its worst performance, it might beat the TIPS bonds. But I wanted to just sort of give you, people ask by, I didn't do gold, but, for the last year or two, a lot of people talk about it as the kind of long-term returns that are Queenie Masters. What's the evaluation of the current situation? I was very disappointed. In the summit, I was on CNBC, and they asked me to rank the summit. When President Trump had his first summit, the President Xi, he was asked to rank it. Trump was on a rate from 1 to 10, and he said it was a 12. So when I was asked to rate it from 1 to 10, I said, it's a -2. I mean, I didn't know any deals, and, my impression was that he was going to, yes, everyone agrees Strait of Hormuz would be opened, that had been stated, but I thought he was going to put more pressure to try to get China to open the Strait of Hormuz. Now, things are changed every hour, right? There's a proposal, counter proposal. Actually, the price of gold as well is sinking now. And by the way, you can see it's really quite connected with the market. I mean, if there's a potential deal, the market rises, and if there's not, and it goes really, opposite to gold. But most people, I think, are really surprised that oil isn't higher than it is right now. $105, and I'm looking at Brent, which is even higher than the WTI. I would imagine that, at the beginning of this war, that was right at the end of February, beginning of March. If I went back, most experts, Strait of Hormuz, which had 20 million, barrels a day through, would be closed. I think almost everyone would say, hi. Now, it is true, so I'm just putting, 6 or 7 million through on their own pipeline, and there are other little leakages there, but a lot of people are surprised that it actually has stayed as low as it is. Is the elasticity actually that high? Must be within short-term elasticity extremely low. How do you get that demand destruction for at least 10 million, maybe 13 million, drawing down stocks? Some people say stocks are much higher than people thought. Private stocks as well as government reserve stocks. Well, I'm not going to go into the debate online. It is kind of fascinating. But the bottom line here is that U.S. is really not that affected by it. And of course, the reason why the U.S. is not affected by it is the fact that, we are the largest oil producer, largest gas producer, and one of the largest oil exporters in the region. Self-sufficiency is very important. Exports are very important, strengthening the dollar. But let me show you here. This is over the last 70 years, the daily production of oil in the United States, Saudi Arabia, Russia, Iran, and China. The blue here, and I do have a razor, so I can. Here we are, the United States. We were at $5.3 million a barrel in 2010, and now we're at 13.6 million barrels a day production. No one has ever had that. I mean, that is, of course, you do see that Saudi Arabia, when it pumped up at some time, but that is really quite incredible. And the Economist magazine put out a Economist magazine, you may have seen this about a month ago, it called the United States Saudi America. This is our energy balance measured in oil and the other energy sources. And we went from 19, sorry about that. We went from the huge deficit 2008, 29, and then surged into surplus. And what caused this in the last 10 years? Yes, fracking. If it were not for fracking, the United States right now would be in a serious recession. And the Dow Jones would probably be 10,000 points lower than ISA. Fracking not only saved us in terms of being self-sufficient in the production of oil, but the production of natural gas that comes from the frack. It's the fracking story is an amazing story of capitalism. The wildcatters said, I think we have another, they went to the big oil producers like ExxonMobil and Chevron and said, I think we have another way that we could get some oil. Oh, we're not interested. They wouldn't fund them. We're looking for deposits off of, South America and here or there. Yeah. And they got their own funding together and did it. And started. No big company, no government was involved. The most important energy development in U.S. history. Sort of interesting how things happen, or don't happen, as far as that's concerned. But take a look at the following. Now that's scracky. Energy intensity of U.S. GDP. How many thousand BTU units does it take to produce, like, say, $1 million worth of real GDP? Well, it could revenue about 50s back to 1950, and now it takes about 5. We are 3 times more energy efficient. We use about 30% of the energy per dollar GDP than we did then. That's why we're not in the mess that we were in, not only exporting, but it's importing back then, but we just don't use it as much. But this is the interesting thing. What don't we use? Well, what we don't use is oil. So here is the oil intensity of the U.S. economy. How many barrels to produce $1 worth of real GDP? Since 1960, it has gone down 90%. Now, first of all, let's review the reasons for all this. Most people should be able to think about the reason for number one. Reason number one is, first of all, we become more energy efficient of the machines we use. Automobiles about twice as energy efficient and other machinery. Also, the shift to a service-oriented economy away from manufacturing. So that helped on length. But what was really, what caused the second one? The substitution of gas for oil. Who uses oil anymore except for your automobile? Most in the United States, most of the biggest producer of electricity is natural gas. Oh yes, there's somewhat. But outside of that, and gas. I know that with fracking, and I'm sure there's people in the room who are climate aware and are perhaps not real thrilled about fracking. But one of the things one does recognize is the greenhouse emissions from natural gas are much better than oil. They're not as good as, of course, hydro and solar, of course. But I'm just saying, if you want that substitute, but the substitute of gas for oil. So do we really care that much about how expensive oil is? Well, for the U.S., not much. Here's actually the real price of oil, going back to 1960, and the jump up recently. But that flat area beginning was, people ask about that. Well, how is, actually the price of oil was set by the Texas Railway Commission. All the oil was pumped in Texas almost, and they dictated and they transported it and they set it. And then, of course, came to be and below and nationalized all the oil, and then up and down, up and down. But, we're not that much. I got a meme from not that much different from the mean price of oil. And given that we used 90% less than what we did, its impact is just pretty minimal. Here's the price of gasoline, which is around now. It was around $3 a gallon. Now it's $4.50 a gallon, and that translates to about, I guess, $1.10 a liter. People here, U.S. I don't know what it is in Mexico. Is that about $1.10? Yeah. Okay, so that's very similar on what it is. Of course, we all know that in Europe and elsewhere in the world with taxes, it's much higher. But here we are. We're not much different from the average rate. And actually, I didn't have this graph up. If I go back to the 1970s, on a real basis, the price of gasoline was $8 to $9 a gallon, with cars that use 2 to 3 times as much fuel to get that. So you can just see the differences here. People, always. Why is this not like? Why isn't this tanking the economy? Well, I'm giving you reasons why it is not tanking the U.S. economy. All right, here's the real price of natural gas, which, by the way, has not gone up in the United States as a result of the Gulf War. And it's on a trend down. You can see the regression once the fracking came into being. In fact, there are places in Texas where it's free now because they can get it transported away. Free gas, natural gas. It's now the major power. So I'm giving you that important flavor. So, why, the knee-jerk reaction was, oh my God, and then the realities are, hey, let's look at the facts. Not so bad at all. Oh, what about that University of Michigan survey at an all-time low for sentiments? So I went back, that's going all the way back, to 1970. So you can read that in his handle. But and I went back and labeled all the recessions, and that yellow arrow in there, that's where we are now, and there is no sign of a recession. There is absolutely no sign of a recession. No sign on any of the high-frequency indicators or low-frequency indicators. This would be like the only indicator that says, where am I? Why is this happening? Do you want to know? So get the headlines in the U.S. So this is interesting. Should I show you why this is happening? This is an assessment by the University of Michigan of how good the economy is. The red line is from the Republicans and the blue line from the Democrats. Now, it's true. I mean, what, are they living in different universes? I just make that. But the first thing you should think about is the interest. The country's pretty divided, right? 50-50. This shouldn't matter. How does it get to be low? And why does it hit an all-time low? Well, I found out, told by others, that the way that University of Michigan surveys, has 70% Democrats and 30% Republicans. No. The conference board, which comes out on the last Tuesday of every month, there's where we are pretty good, and they make sure it's 50-50 in their surveys. So I think we got an answer to why, I mean, it makes headlines, consumer confidence, universe, and I mean, I don't understand why they don't make these corrections. I mean, it's a 50, 60-year-old, well-regarded indicator, but it certainly is giving false signals, because nothing's, at this, if it was at an all-time low, the consumer would be in the tank, right? What about monetary policy? Oh, well, I'm really looking forward to that June 17th meeting. Kevin Warsh. I'd love to be a fly on the wall. Listen. Now, Warsh has promised a lot of things. He's, talk about changing the whole dot blocks. A lot of dot plots are ridiculous anyways. I actually think they could have one or two next meetings. But the idea of they know what happened a year from now, a few years, and 3 years, maybe they could have a long one. What I do is the steady state they can afford. I'm going to talk about steady states that are also important going out there. He also may have to press conferences, all the rest. Now, a lot of people talk about the balance sheet changes that Warsh has talked about. I'm going to give you a chart in just a moment about the balance sheet. We'll take a look at. Let me say the following. Of all the things the central bank does, and this is the way it works in the United States, there's setting the Fed funds rate, there's the balance sheet, there's reserve requirements. Oh, I haven't been changed in half a century. There's some regulation, which is slow moving. Of all those, setting the Fed funds rate is more than 10 times more important than all the others put together. And why is that? Because $15 trillion, trillion with a T, dollars alone are directly based on that Fed funds target. The prime rate is set 300 basis points exactly, and moves on the day above the Fed funds target, midpoint of the range. I don't even know why I have a range anymore. So stupid. They had a range when they used to use the open market operation to determine the rate. Why do they still have a range when they set the rate on reserves? Really, it's kind of stupid, but nonetheless, that's what. All right? But that's so all the home equity loans, all the auto loans, it's the LIBOR rate, because they don't use LIBOR anymore because too much scandal. So they now call it SOFR. All the SOFR rate, all the, I mean, you could go on and on and on. So, how important is that Fed funds? People say, oh, Professor Siegel, no one trades Fed funds anymore. Yeah, really, it doesn't get traded much anymore. Doesn't matter. It's called the Fed funds rate, doesn't get traded. It's set by fiat now because they set the interest rate on reserves, which they never get before 10 years ago, and that's the rate, and that determines the short end of the term structure from which all other rate emanates. Like we Keynes just talked about that. Let's take a look at a couple of Look at the term structure, balance sheet, well, first of all, I wanted to show you, this is a nice graph. This is the balance sheet since the founding of our Fed, 1913, all the way to the present. It's sort of interesting. You notice that there were almost no reserves before quantitative easing. You see how it just like disappeared? And the whole balance sheet was because of currency. Currency is also fascinating. Since young people don't hold it, and many other people just don't hold it, but that doesn't matter. It keeps on growing. Now, all those deposits, why are they being held? Because interest is being paid on. Right? When interest rates were zero, they were big held because everything else was zero. So why not hold it? But then when interest rates started rising, see, they had a big problem. How are we going to set the interest rate?
You know, there's so much excess reserves around. The Fed would have to do trillions of dollars of, open market sales to absorb all those excess reserves. I would have chaos in the market. Oh, I got an idea.
Let's just set the interest on reserves. Big giveaway to the banks, though. Now they used to get nothing on reserves. In fact, by law, all the way from 1913 until, I think about a year or two before the financial crisis, Bill passed Congress said you could pay interest on reserve for petty. Crowley was allowed to do that. They didn't do it till finally they had to do it when they raised the rates coming off the zeros from that. So all that is held. Do we need to get rid of it? I don't really know. I mean, it's a real, we don't have to, I don't want to go to monetary theory. It's fascinating. We have given up on the Fed funds market, which used to be a signal for the short run, the Quinby markets. The Fed would go in, oh, how's the Fed funds trading? Oh, it's trading 10, 15 basis points below target. Okay, what's this? Well, we do a couple $1 billion over market sales, tighten up the reserve rate market. And if it did it a day after day, they said, someone's telling you that reserve demand is weak. Maybe we should lower our target rate. That signal is now completely absent. And there's a number of economists that say that is a big loss. We could debate that, but it isn't, because the rate now is set, so they get nothing from that. They have to look at other variables. What other variables are they going to look at? How about the term structure? Oh, everyone's talking about, the 10-year rate is telling us to got to move up that Fed funds rate. The average over the last 55 years spread between the 10-year and the Fed funds target is 108 basis points. About 100, that's it. That's kind of a normal term structure. So you could do it off of that. So what is the 10-year right now? 465. And what's the Fed funds target right now? 365. Oh my goodness. Right on target. When 10-year was down at, now there's others that do different ones. Jeffrey Goodlock actually used the 2-year, which is already up at 4. So he thinks 1 or 2 raises is necessary. Or if you want to use that as a guide to whether you're, stimulate or not, as far as that's concerned. But hey, this is what I love. Unsupply. Having been educated at University of Chicago, being honored to be a college. Educated at college. I actually never went to school. But my first teaching position at University of Chicago, Milton Friedman was a colleague. It was his last 4 years, my first 4 years as a young assistant professor. And I remember sitting at the lunch table all the time with him. And he was talking to me. He said, Jeremy, if you have a burst in money, you're going to have inflation. It may not happen that month, and 6 months if it's going to happen. And many of you know, this is, put some wrong button over it. 30%. Many of you know that I was on the news networks and CNBC. This is March 2000. Oh, we all know. And the COVID crisis. We just flooded the place with liquidity. But then we didn't stop. We kept on flooding with liquidity. The government kept on. So there were 4 stimulus packages. The first one, Trump was president for sure. The first one, yes, okay, crisis, throw money at it, we'll argue maybe. The second one, not really necessary. The 2 Biden ones, totally unnecessary. $5.4 trillion. Now, what should Jay Powell have done if you had taken monetary theory and policy standard in your economics book? It should go to Congress and say, listen, you passed it, you raise it, you go to the bond market. And what would happen to interest rates? They're going up right away. Whoa. They may not even done all that, which was unnecessary. But no, what did Jay Powell do? He just ran the printing presses and handed the money to the government. That from March of 2020 to March of 2022 was the biggest 2-year increase in M2 money supply in history. And remember, it was Milton Friedman, Monetary History of the United States, who determined and calculated the M2 money supply and showed how important. He was the one who basically said, and almost, I would say 90% of the economists now agree. At the time before you wrote that book, if you would ask, most economists, what caused the Great Depression of the 30s? Which so dramatically changed politics, probably caused World War II, glowing to whatever. Stock market crash, the Smoot-Hawley tariff. He said, no, particularly not the stock market crash. That was 29. They'd already covered 2/3 of it by 30-31. Smoot-Hawley tariff was bad, but that was implemented after the market and the economy hit its low. No, it was the failure of the Fed. The money supply shrank by 35%. Unbelievable. The Fed was created 20 years earlier to prevent that. But we didn't have, bank was like J.P. Morgan go out onto the floor of New York Stock Exchange during the panic 1907 and say, okay, I'll save the world. We need a central bank. We were the last of the major countries to get a central bank. As you know, by far, Europe had a century. Hey, I'm going to do that. But that was what I kept on criticizing about Powell for. Well, after all that inflation, which wasn't temporary and never was, he slammed on the brakes, setting the Fed funds order up to 5. And then we were going along at a pretty good pace again. Actually, I felt a little slow, 4.5. I got 5.5. Why? Because, monetary theory of money, rate of growth, quantity, GDP, and then prices, 2.5 on prices, 2.5 on GDP, you get about 5% on that. They're established out. And look at the money supply before the COVID crisis, which really very stable. This on logarithmic.
All right. So I was saying, I could see maybe room for one cut on the base, just getting the money supply. Take a look what just happened in the last month, actually, since the Iran. And by the way, I did have it. So I looked at it. It comes out every Tuesday. The Fed, that thing has jumped again. People are borrowing ahead of inflation. They're trying to stock up on inventories. People are taking out loans before prices go up. This is not good. Fed's got to raise. Fed's got to raise. Signals are coming from the term structure. Fed's got to raise. Signals are coming from the money supply. How many people here read the CFA report that came out 3 months ago?
the AI apocalypse. So on that day, for those who didn't read it, it started circulating. The Dow was down 6,700, but certain industries, he described the apocalypse. He said some industries are totally going to collapse. And one of them was the payments industry. That these Visa, MasterCards, and American Express totally going to be gone. Do you know they were down 8 to 10% on that day? Now these are huge cat stocks on this report. All right. And then there were other stories about collapses here or there. Everyone, students are going to start defaulted on all sorts of debts. The mortgage market is going to go into default. And the U.S. is on the verge of another Great Depression. That was the Citrini report. Now, let me tell you, when I read this Citrini report, it read very well. It was interesting. It's like someone figured out 2 or 3 scenarios which they talked about in detail, and then fed it into AI and said, make this interesting. And they did. And yeah, $1 trillion came off the market. The macro, I'm not going to talk about the individual micro stories. The macro stories are appallingly bad in Citrini. Okay, they don't know any macro at all. So I said, listen, that's good. Look at it. I got my degree in economics, not in finance. Macro economics at MIT, PhD. So I did also general equilibrium. That's what I did. Take an example, change a parameter, and try to figure out what the general equilibrium results with it. See, that's why I like lecturing you. You understand all those tricks. So I decided, let me do a thought experiment about what might happen. So it was about, and by the way, what people ignore is productivity raises wages so much, it generates so much extra income and demand. Okay, so here's a thought experiment that I read. Let's say I coupled everyone's productivity. I know it could to do that thought. So everyone could do twice as much per hour. Well, we know that wages and productivity move 1 for 1. Marginal product labor is that. What is a wage? Marginal product labor output per unit hour. You go through the math and it goes through the historical data. You could find it. By the way, there's St. Louis Fed string 1 people. So they look at it, it's not following that. Well, what they didn't put in is the benefits. All the benefits so they did wages against it. They didn't do wages with benefits, which have gone way up. And it matches once you put that in. So what's going to happen? If it takes, the people were fed as a week, and we produce, let's say, a $30 trillion GDP US, we're a little higher than that now, about 30. With doubling productivity, you could produce in 2.5 days, right? If you double your productivity, you could produce exactly what you do now in 2.5 days. That'll give you a 2.5-day work week and a 4.5-day weekend. And you'll have $30 trillion worth of GDP. Now, but there's something also interesting. Wages have doubled. What do you think the incentives are right now? Just a minute. I like a long weekend, but if I just work 1 more day, I will increase my income by 40%. Right? Wow. So that will be nice, because then we'll have a 3.5-day work week and a 3.5-day weekend. Everyone will leave Thursday at noon. Some people do that now. And GDP, by going up 40%, math is real simple. On the $30 trillion, $16 trillion $12 trillion. $12 trillion more demand. What do people demand? Everything that they wanted to buy, they can't afford now. Right? The second car, the third car, the fancy restaurants, the cruises, the vacation homes. You go on and on and on. The demand is going to be enormous, especially on the luxury goods side. I mean, people are found. You know, we call that the American dream. It's really kind of a middle class dream for many countries where I can get these things. It's going to be realized by not everyone, certainly, by a huge number. So, Pete, you know, this idea that you are trained in a certain area and that's all you're good for, that's the AI labor apocalypse. But that's wrong, because studies have showed that over 90% of the skilled, the white collar workers are fungible, but they're transferable. Yeah, they do some specific trade. Oh yeah, I'm not doing this, but this now, this fancy restaurant chain is really expanding because reservations are way up because the incomes are so high. And, I think I'm going to be, they're looking for people mapping out their road for profit and expansion. I'm just telling you about the ships that are about. Is you can ship. What is the white collar? Minimum education, minimal skill set, being able to interact with people. There's a minimum skill set that we call the white collar worker, which is transferable in almost every case. Now, for some people, some skills will disappear always, and they always do. And this story has been told many times before. The story of the radiologist. 10 years ago, a labor expert called Jeffrey Hindy, commenting on how AI would change the workplace, said, stop training radiologists. That was in 2016. So we have 10 years since then. The green line is the number of radiologists, and the orange line is the income of those radiologists has gone way up. Now, the radiologists are reading 10 times more scans than they did back then with the help of AI. Of course, AI can make scans so cheap, they're going to be as cheap as x-rays, which would be then, 100-fold increase on scans. So, it was a labor conference. I mean, I read about this. I'm not a labor economist. He started telling about stop training. That. All right. What about, I remember when Excel came out, bookkeepers were going to be gone, accountants were going to be gone, everyone going to have a balance sheet. Well, that sort of shows the number of bookkeepers that has occurred since person. And then this just came out last Saturday in the Wall Street Journal. Remember when everything went online to get your tickets, and in fact, travel agents were charging like $25 extra if you just wanted to get a ticket, and everyone said travel agents are disappearing? Who needs a travel agent in the digital age? Apparently, more people than ever. For luxury vacations, actually, you could ask for a luxury vacation on your chat. It gives you that, but the demand is amazing. I mean, LinkedIn says it's one of the fastest growing areas. This was supposed to be a profession that was supposed to be out of business. And we could go on and on. Most projections in 2000 were that 50% of all purchases would be online by 2025. Now it is 20 in the United States. That's a big chunk, but it's not 50. I mean, I'm just telling you what people project and then what finally happens. So right after the Citrini report, get this, Anthropic
Okay. Few days after the Citrulli report, and it wasn't connected, it wasn't in the spot of the Citrulli report, but Anthropic had been surveying 40 different industries and assessing the potential of AI to save substantial costs in those industries. That blue line represents how much cost savings, and if you're near the border there, and you could read the professions, along the way, that means they're really substantial. And of course, if you're down 01 was ground maintenance. Well, if you don't include robots, you need the physical people. That's the zero, that blue area there. But they get 40 different professions. But this is what struck me. The red is how much has been done so far. Slow adoption. Goldman Sachs does a quarterly survey on adoption of AI, and they say it's slower than they anticipated, almost always. There's been a number of academic papers about adoption technologies and adoption. So there's two things that cause adoption. If things are good and you're making good profits, you're not going to come in and tell, I'm firing you and you. It just doesn't work. It has to be a negative shock that forces you to adopt the technology to maintain a profit stream. Now, that could be anything. It could be an oil shock, could be a terrorist shock, it could be anything, a shock. Or some young people are going to come along, were trained in AI, and go to the customers and the people that I'm using and say, I'm going to give you not only the same product, a better product at 50% cheap. And then you are existential. You will not survive without doing it. Time and competition will force advancing. Will force the use of AI. And everyone that does use it are going to be able to scoop up all those profits that come along with it. Wow, let me show you AI prompts. Everyone talks about fiscal unsustainability of U.S. government debt. Well, that green line, the big line, is the debt to GDP ratio since the foundation of the United States, since we had the Constitution in 1787. Down, we paid it off. Then we had the Civil War, then down. Then we had a Great Depression, and then we had World War II. Big increase. Then we paid it down, and then we started spending. And spending there were the wars, but they weren't the major costs. And it was all the entitlements and other junk that we get, and it kept on going up, and now it's unsustainable because it's rising faster than income at an accelerating pace. Yeah. This Congressional Budget Office is the best arbiter, the best organization. It, of course, does all these calculations.
So what GDP growth rate do they assume here?
1.8% per year. So a number of economists and in-cap legislators asked the CBO, the Congressional Budget Office, Congressional Budget Office, well, what happens if we're more optimistic on growth? Suppose AI can raise GDP growth by 50 basis points a year. That's not crazy. To 2.3%. So they said, well, I can do that. I mean, anyone third grade could do that. That's not hard. But look at the line. Look, it goes quickly to a max and actually tips over. Now, that is funded debt. They talk about the unfunded debt of I'm on, but yeah, it is pretty amazing, isn't it? Now, I said I would circle, and I talked about the Fed. I said I was going to circle back to something. During Powell's last news conference, so I was the commentator on CNBC. to do is listen to the conference and then analyze it afterwards. Brian Sullivan was a guy there. So he said, all right, Jerry, this is it, presented his speech, and what struck you? But I said, well, we all knew he wasn't going to do anything, et cetera, and so on. The thing that struck me the most was that the Fed raised their long-term estimate of GDP growth from 1.8 to 2.0%. The biggest 3-month increase in their history. Now, what amazed me is there were 80 reporters in that room and not one mentioned it. I thought that was really significant. I mean, they raised it 40% in 3 months, raised it 40% of the way to control our fiscal deficit. But you see, that's the problem when you don't know macro and you're just focused on something narrow, and you have to see the big picture with everything, if you will. I thought that was really. We'll see what happens in a month, because it's the SEB, the Survey Time of Projections, comes out every 3 months, even though the meetings are, as you know, about 8 times a year. How are we doing time? So we pay? Almost. Oh, how about the PB of the Marple? Is it too high? I guess you might be interested in that. So what is the right PE? Is it last 12 months or next 12 months? It's really next 12 months if you actually do the theoretical. But of course, we have to estimate the next 12 months, so a lot of people do it on the last. So we're good in the United States. It's like 21. In fact, okay, so we have all here. All major heart. So this is, I will say so, actually. Can you hear me? Jokers. Sorry. So let me come a little closer. I might be able to read this over here. So if you go ahead 12 months, you should do a weighted average of 26, 27, right? By the way, so we're not quite halfway through the year, but so the Dow Jones is 21.56 times this year's earnings and 19.22 times the next. S&P is 21.19 and a quarter. So, mixture is like 20 and a half. That's not there. I've written papers, I could think would bring PE in the market, and forget about super growth or AI or any of that. Should be 20. I know historically it's been 15, 16. And the major reason why it should be creeping up over time, which it has, is the dramatic reduction in transaction cost and ease of getting a fully diversified portfolio at negligible basis points, unobtainable in the 19th and early 20th century. How much do you think it would cost an average person to get a fully diversified, float-adjusted portfolio of every stock trading? Remember, fixed commission, bid-ask spreads, and everything like that. 100 basis points a year of transactions costs, maybe 150. So yeah, you're getting 6.5% real on the market. That's been true of 200 years. The index, you were probably getting 5. Well, 5 is really what's necessary. And there's no transactions costs. What B corresponds to 5% real? 20. 1/20 is fine. It's a real asset. Okay, we could talk about it. So we're not really anywhere far, and the rest of the world looks pretty cheap. Now NASDAQ is 28, 23. There's Toronto, and there's Mexico. Really cheap. It is really cheap. Not as cheap as Brazil, which is the cheapest and the best performing in dollar terms year to date this year.
Then we have all of Europe, which is 16, 14, FTSE, CAC, DAX, IBEX, the MIB in Italy, and Stockholm, and then the Swiss is out of the Eurozone, so it's 18, 17. I don't like to use up at the Nikkei for but go down to the Topix. Nikkei is too select, too undiversified. You got 18, 15. Take an average there, you're going to get something like 16, 17. Think about this. If you have a 15 PE, you have a firm with a 15 PE has no growth. It does keep up with inflation. It has a 15 PE. What's its real return? What's a 1 over 15? 6.7. Oh, isn't that curious? That's the long run real return on the market. And that's also the really long run PE ratio. Gee, isn't that interesting? Interesting. It's like, I'm always shocked because I look through finance books and I said, where do they talk about that? Like they don't. I don't know why. You see the relationship? There are always relationships. And then, both value to growth, looks like we were having that rotation, and then war came. I didn't update this. I didn't have time. It's actually gone, All right, so WN, and by the way, this is the big value growth. That's the internet, but this goes back 1990. So that's the internet bubble. Let me give you this one. That's the internet bubble. This is growth versus value. So we all have 100 years. Center of Research, security prices. Now, when that important data set, I think it's been sold. But that's the Palmer French data set. Morningstar, right? Didn't they buy it? I think they did. That's the Palmer French. We have never had a period, ever, in the 100-year history, where growth outperformed value by as much and for as long as it has over the last 15 years. Unprecedented. And what's also unprecedented is the growth of the earnings of those growth companies. Here, there were no earnings growth. It was just wildly optimistic about what the future would be. This is backed up, not everyone, but mostly backed up by earnings growth. But I'm going to end my formal, we're going to the very last graph. People ask me, did I see any froth in the market? Little bit on the trip side. I get the following thing. People would say, well, why? The chip has doubled and tripled in price, this stock, that, Intel, you go through them. Its earnings have doubled or tripled. I said, okay, so let's go to the basics of finance. Its earnings have doubled or tripled this year. What percent? So let me ask you, CFA graduates, a stock with a 20 PE ratio, what percent of its value is determined by its earnings or cash flows, if you wish, more than 1 year in the future? 95. 5%. Basically, each year went on discount. So 90% is over 2 years. So we have a 2-year surge. And it doubles its earnings, and then it goes back to normal. The stock should rise 10%. I mean, this is really simple discount. You know what you do in week 3. So the only way you could justify it is it's going to go up, stay up, or go up and just keep on going. You know, an industry which has been subject to competition and subject to cyclicality in the past. It might happen. Now, I'm saying those are the chip stocks. You know, you also have those very special, the Googles and the other Macs. Tesla, a different category. 200p, different pepper. It's on options, all on must options. And, but the rest of them, 20 to 30 with NVIDIA, 17, 18 times next year's earnings. Why are those so cheap given their, you could ask, why are those stocks so cheap? And you know, I'll tell you what it is. Technology is changing so rapidly that we don't know whether the enormous moats and margins that these companies have will stand the future of time. Who knows when an announcement might come out of anywhere, like China. Oh, we got a chip that twice as good as Blackwell at half the cost. Oops. Ooh, I should have sold NVIDIA yesterday, shoot guy. All right, let me end with this. I'm ending now. Waiting for your question. All right, this is the first. I have to do this carefully or I won't get there. There we go. Okay. It's really quite astounding, is it not, that these wiggles in this stock line represent 6.9% real growth, are the great bull and bear markets over time that so frighten investors. How many articles have been written about the equity risk premium? Why is it so high? Why is stock 6.9 and bonds 3.3? When actually, in the long run, in purchasing power, stocks are actually more stable than bonds. I'm not talking about TIPS, I'm talking about the standard nominal bond. TIPS, you can get it too. Oh, so TIPS, you can get it too. 20 PE is a 5% real return. The TIPS are too. I mean, that's crazy. People around tell me, oh, it's all inverted. I can get fined at 0.5% in corporate, but that's nominal. I have to do real to real. Apples, oranges, oranges. So you get 2 on TIPS, a 20 PE stock with no growth, extra growth, outside it just existing, gives you 5. That's a 3% equity risk premium. Well, yeah, that's a little smaller than history, right? What's history over 224 years? 3.6. So, I don't know. People talk. What's crazy about the market? What's crazy about the market? Well, is there anything really out of line here? Yeah, well, what I told you before, these Max 7s are never been seen before and don't know an answer. I know you all waited. And waiting for me to, but I don't know. I'm honest. I don't know when their run might end. I think their risks are being balanced by unbelievable earnings, which if you knew would go up, they should be 3 times the value they are now, versus technology going to do them in, and they're in that balanced state. Not overpriced, not underpriced, that I can see it. Do many of you actually help manage money for others? Some of you do. So let me, a lot of times, in bear markets and recessions, you know that it's going to come. And I always get calls when there's a bear market in their bear. And they all ask me, they said, Professor Siegel, what should I do? Some say, I've got the answer. First, go to the store and buy a copy of my book. Turn to page 6 and look at this graph. Get yourself a nice drink, sit down in your lounge chair, and relax. Thank you very much. You've been a great audience. Thank you. Anyone want to raise any questions? Hands. Yes, sir.
So, energy, private credit, energy, AI. The thing is that productivity depends on energy being there. Energy is a long cycle product.
Okay, with that.
We're at coming time.
So you want to start at the beginning, because some may not have heard. Now that you're back to your comment.
So basically, AI depends on energy. Energy is long cycle.
Right.
Will we have the productivity gain sign interaction?
Yeah, I think so. I think the productivity gains out. Yes, I know it's a big political topic now. You know, when I think about all these people against AI, okay, and they use that, no, AI only uses about 3 or 4% of the illness. It's not big. It actually has more water use, and there's some questions about that in terms of that could be more of a scarce resource as far as that. But, you know, it's this same sort of thing, the energy, that, you know, was the same sort of thing that was said against fracking, which saved us. Now, it's sort of interesting to think about all these arguments against AI. Well, forget about all the potential benefits and don't concentrate on cost. Almost nothing doesn't have costs. Through history, doesn't hurt somebody. But technology, we know through history, has helped mostly. Anyone else? Yes.
Yeah, here. Thank you very much for your presentation. And my question is you talked about how the way we invest has changed over time, the cost of building a portfolio, and now with all these ETFs and all these indexed funds and everything.
Yeah.
What is the risk of all this new money coming automatically to the index fund ETFs? I mean, it's a topic that's been talked about in the whole world.
We have a real good thing, and I'm going to change maybe your question a little bit, but you want to. I get a question all the time: is there too much indexing? So, and people say there's no way to answer that. I say no. There is absolutely a way to answer that. And they say, well, how do you know when it's too much indexing? There is too much indexing when active fund managers, after their costs, on average, beat the index. Did you catch what I said?
Yeah.
And you guys are smart enough to understand what I said. The equilibrium, what's the equilibrium in that space? When active managers after costs do as well as the index, risk adjusted and everything else. Are they there yet? Well, from the data we get, they're not there yet. There's a few, and there may be a time when that will happen. But that's the equilibrium. So, in general, I say no, we're not there yet, but yes, it is theoretically possible we will get there. Anyone else?
Yes, thank you for the presentation. It was enlightening as always.
Thank you.
New Chairman Walsh has mentioned that a better way to measure inflation would be to do a mean rather than the way it's been done today. That would imply that maybe inflation is 100 basis lower. Do you agree with that, or does this make any difference?
There's trim mean, there are so many different, well, you know, when you teach macro, you have to teach the theory of price. There's no perfect price index. There's no, a price index, there's the Las Bears and there's the POSH, depending on you, based on all that, and there's the ones in between, and there isn't anyone. Now we have the PCE, as you know, first consumption, and the core, and all that. And I would be very loath, to really make any change right now. I'll tell you where I think the biggest failure of our U.S. indexes are, and it's the way they treat housing. And I won't go into it, but it's really bad. It's real lagged. They did pick up the inflation in housing, which was extreme from 2020 to 2022. And they're not picking up the decline in housing prices that actually came afterwards, and that gave distorted. That is many times more important and gave bad signals to the Fed. And it has to do with them treating it as a capital good and like depreciating the price and craziness like that. It really doesn't make sense to me. Those problems, I think, are more basic. than whether we're going to trim the mean or this mean or take this out and that out. That's how I would like to see it reformed. Anyone else?
Sure.
I know it's late. I know you guys from back.
Over here.
Oh, over there.
Thank you for your presentation.
Yes. There we are. Thanks for waiting.
What are your thoughts about the U.S. dollar? I guess that's relevant for us that we're living in the
Yeah,
US.
I mean, so why is your peso so strong?
Because of the dollar is weak.
No, dollar isn't that weak. Your peso's just too strong. Well, all right. So Trump kind of screwed things up when he got to office. We know that. So that they all went down. Since then, it's actually been trending up. And actually, theory would tell you that as oil prices are going up, being a net exporter should help the dollar. So if we see a spike, like if there's no agreement, and it really goes to 150, 160, that technically should have without because we're net exporters there. And you do see actually there is some correlation there. Not as much as I thought there would be, actually. I thought we would see more strength in the dollar as a result of this oil price increase. But theory would tell you that if you're a net exporter, something goes up in price, that currency should rise. We know that. I mean, petrocurrencies and all that. Canadian dollar, for instance, that just moves with oil. But we have not moved very much. But actually, our trend has not been down over the last 6 or 8 months. So, it's your peso has been really strong. Anyone else?
Sure. Hi, Professor Siegel.
Oh, over here. So we make it I don't want to keep people up. I go on forever and I don't want to keep you up.
The last question, please.
Last question. So the last question. Who gets the last question? Who's got the mic? The person with the mic.
Me. Here, to the left.
All right. Wave. I see you. All right.
Hi, Mr. Siegel. Great presentation. Thank you very much. I was wondering about, they've been making some comparisons on this CapEx cycle with all the AI infrastructure. Do you see similarities to what they made comparisons to, like the fiber optics?
Well, I was just going to bring that up. So, the story of fiber optics, that first, the internet, JDS Uniphase, Nortel's, we needed billions of miles of fiber. And then all of a sudden, they devised multiplexing through the fiber that increased the throughput of the signal by 1,000 times. What happened to those companies? They don't exist. Now, it's an interesting, so one has to think about that. Is that sort of a situation possible here? Could there be, is there, quantum computing, or is there a possibility of a breakthrough which will suddenly make these hundreds of billions of dollars of data center expenditure useless? I'm not an expert to know. I think there is a possibility. I think that's like one of the possibilities why they're selling it, 20 times earnings, or 23. So, yeah, these are the technological breakthroughs that can change the world. 70% margins are just not normal in the long run. I mean, NVIDIA races and stays ahead. These are amazing companies with amazing CEOs. But the threat is there, and I think recognized by the market. You guys are wonderful. Thank you. Drive safely. Going back. Hope to come back to Mexico.
Thank you. Professor Siegel, everyone. Thank you so much for this very insightful long-term view, which is often so rare and sometimes short-termism is favored. So this coming back to basics is really fundamental for every one of us, and you leave us here with lessons. Once again, thank you, Guillermo Rodriguez, for making all this possible, having Professor Jeremy Siegel here. Thank you once again. It was amazing. Ciao. Thank you.